Hello and welcome to today's episode of Nucleus Investment Insights. It's been a pretty big week for fiscal and monetary policy around the world. It started off with the Federal Reserve in the US raising rates again and committing to do whatever it takes to fight inflation. Then there was an incredible mini budget from the new UK government, which was so audacious that even the International Monetary Fund felt it had to comment. So today we're going to discuss whether central banks are going to crash the world. My name's Sam Kerr. I'm a Senior Financial Advisor at Nucleus Wealth. Today, as always, I want to welcome the Founder and Chief Investment Officer at Nucleus Wealth, Damien Klassen. Damo, welcome.
Sorry, Sam. I had a few technical issues here. I think I'm back.
Excellent. We can hear you loud and clear now. Excellent. So we also have David Llewellyn-Smith, our Chief Strategist. Dave, welcome.
Thanks, Sam. Good to be back.
Excellent. Great to have you, as always. We also have our Chief Operations Officer, Shelley George. She's the host of Nucleus Wealth and Power podcast and is also a fierce advocate for doing what's right and raising awareness on important issues. Shelley, welcome.
Thanks, Sam. Great to be here.
Nice one. Thanks everyone for being here. I think it's going to be a really interesting discussion, and it's a question that's on many people's minds. So just a quick reminder before we get started. If you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, you can follow us on your preferred podcast platform, as our show is available on all the majors. And also you can ask any questions for those of you that are watching live, and we'll do our best to answer them during the show. And as always, if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view these at nucleuswealth.com/webinars. So now we've got that housekeeping out of the way. Shelley, I'm going to pass it over to you to get us started and to give us a bit of context around the topic.
Thanks very much, Sam. So I guess this all started for me wanting to be part of this discussion when I saw a newspaper headline in reaction to last week's Fed announcement, and it read, "The jobs that must go to curb inflation." Discussed the possibility of the US having to lose more than 1.5 million jobs in order for the Fed to decrease US employment and get inflation back down. And I have to say, it really blew my mind that we were talking about a taxpayer-funded institution seeking to achieve the destruction of jobs and quality of life, and that everyone was okay with that, that's the norm. And you know what? Don't get me started on what's happening in the UK, where we've seen an actual financial crisis as a result of the new government's fiscal policy being in direct opposition to the central bank's monetary policy. But don't worry, we'll get started on that. So I guess what I wanted to do today for a little bit of agenda was start off with a bit of a foundation around inflation and central bank independence, and then weave into that what we've seen recently on monetary and fiscal policy front, as well, of course, what we might see, and obviously what that means for investing. So Dave and Damien, if I could get you started, can you talk to us about inflation targeting? What is it? How did we get there? And why are we here?
Right. Let's just start with the big part. So look, inflation targeting's and from an independent point of view, is that where you want to start, or just?
Yeah. So I guess I think if you're going to talk about inflation targeting, you're never going to get to a point of the creation of central banks, which is relatively new, and they're independent. So I guess
the creation of central banks has been around for a long time. It's the independent part, and I think the central banks originally set up to help provide liquidity and stop the idea of the run on banks that you used to have 100 years ago. And then it grew into this. You've got sort of two arms of really how government would manage the economy. One was by raising or lowering interest rates, and then the other one by spending more or less. And then eventually, as time went on, an idea that gained prominence was that, look, politicians are far too slow to slow down far too slow to react when economies are overheating, and they tended to want to the party's happening, they tended to want to keep pouring the alcohol into the punch bowl, and as the way they say it, they need somebody whose job it is to take the punch bowl away when as the party's getting to full swing, so that it doesn't get out of control. And so that's where this idea that, look, we can have independent central banks where they're not, politicians, and they've been given these mandates to try and maintain employment and, in some cases, currency stability, and then also keep inflation under control. And so that's sort of where we got to. Whereas, like, okay, that makes sense. And the question we're going to look at today, and in a number of different cases, is, has that devolved so far that we're getting to the stage now where we have governments who are effectively saying, we'll try and do all the fun stuff and the stuff that people won't complain about, and give tax cuts and spend money and all that type of stuff. And if anything goes wrong, we'll just blame the central bank. And we're sort of like, they're almost as if the government's starting to get to the stage where they're like, well, we're not really in control of the economy. That's somebody else. And so
that sounds a little bit like Scott Morrison to me. Not my job.
Well, let's not. We won't go there. But I think there's certainly. We will talk about Australia a little bit, about working in opposition for a long time to like Australia sort of not started it, but we had a decade of where the government was looking to try and balance the budget and get back into surplus, and at the same time, and so effectively pulling away from demand. At the same time, we had this central bank just lowering rates, trying to get demand up and trying to get wages up. And so effectively, you had a government working in opposition to the central bank for a decade for Australia. But that was a minor version as well. Yeah.
Right. So can I actually
maybe not a minor. That was important, but it wasn't as it's certainly not as extreme as what's happening in the UK now, where that's
pretty extreme. I mean, the IMF have come out and said something against them.
Yes, you've taken the two opposite ends of the spectrum.
So before we get into that, though, I just I guess I just want to understand a bit more. You said that central banks typically would focus on maximizing employment, economic stability, and keeping inflation under control. So why is keeping inflation under control important?
Yeah, well, I think the issue with inflation is that the extremes of inflation is what causes lots of problems. If so, you end up in deflation. That's sort of you got the Great Depression. Sort of was deflationary forces which helped to drive that and make that so much worse. In terms of so that's one end of the deflation, and at the other end you get the hyperinflation periods where they use Germany, Weimar Republic, and Zimbabwe, and these places where the shopkeepers are raising their prices throughout the day. In terms of, it's like, yes, your banana starts the day at $1,000, and by the end of the day it's worth $3,000. And so the issue is, and that's highly disruptive as well, and causes lots of issues. So it's about trying
social issues involved in that as well, right? And so, but where would you say hyperinflation starts? Is it 50% per annum, 20% per annum?
I think there's a definition. It's over 20. I'm not quite sure exactly where the definition starts. I mean, I think there's certainly an issue though with higher inflation. But having said that, like, in terms of how low is too low of inflation, like most countries sort of have this 2% benchmark, and I'd argue that as they want to have inflation below 2%, I'd argue that it should perhaps be a little bit higher. Australia 2 to 3% is better, and maybe it needs to be a little bit higher again, just in terms of being able to have a bit of a. For me, it's it's almost the oil that helps lubricate the engine, in terms of it makes transitions easier for companies, in terms of you can. If you've got companies that are in sort of shrinking industries, they can sort of be holding their prices still and holding their wages still while the rest of the economy grows, and it's not sort of catastrophic for the people involved. And eventually they start shutting down a bit more naturally and moving on to other industries, or people start quitting and moving to places where they can get higher jobs. It's a little bit more natural. Whereas if you have to start forcing those people to take pay cuts and to and forcing companies out of business more quickly, that can cause just as many problems. So really, it's about how do we enable transitions, and how do we enable resources in the economy to move to productive areas, with causing the least amount of disruption to the economy, is really what the idea of having this moderate level of inflation that sort of helps that. And also it's this idea that if you do something for me today, Shelley, and it's worth $1, and you decide not to spend that, you decide to save that, is that then saying, well, in 50 years' time, if you've got deflation, does that mean, you've done a token effort for me, but you've got deflation, so in 50 years' time, you can then turn around and demand, masses of things, because that dollar is now worth so much more than what it was when the day you did it, and vice versa is, you don't want it to be worth nothing, but maybe it's the fact of saying, well, if you've done something for somebody and earned some money, and then it's their turn to do something for you, is that the difference in that, favors that you did 20 years ago shouldn't be worth as much as a favor you did yesterday, so to speak. It's like,
also deflation in my mind.
Value of it.
Deflation is problematic because it discourages consumption today and encourages you to hold on to money and wait until the future. And then that's this continual spiral down for the economy, which leads me to the concept of recessions and economic stability. And I promise we will get to the UK in a second. But would a recession fall under economic instability, or it's actually still,
well,
maybe it depends how bad it is.
We've certainly had central banks, I think they declared victory a few years ago, Dave, didn't they? That just before the financial crisis, in terms of saying, we've solved the economic cycle and we never need to have them again. I think to me that's similar to saying, I've managed to stop the bushfire, and I've managed to keep them away for like 5 years, and so now I've solved it forever. Is like, well, no, actually, we've had all this underbrush now growing up, and so when accumulating and all this fire hazards accumulating. So when you do have one, it's actually going to be a really big one. And so I do think there's I don't think we should be scared of recessions themselves. I think we should be scared of deep ones. I think that's and I think a fire is is a good analogy in terms of saying it does help. Smaller.
It's
things
cleansing,
every now
right?
and again helps the whole system grow. Whereas if you avoid it, then you'll end up with, there's an economist named Hyman Minsky, and that's often people hear about the idea of a Minsky moment, and basically his theory is that stability begets instability. So if you get too much stability, then all that happens is people just start taking bigger and bigger and bigger risks until one day they finally reach the limit. People just want to keep pushing the limit, and finally when they do crack it, now you get a massive problem because they've taken such massive risks, and arguably that's a lot of what came back to the financial crisis in 2007 was people taking like just hugely leveraged risks with the view that, look, these things have been stable for so long, and central banks have said they've sorted out the business cycle, and we don't have to worry about it anymore. And so and that's
and potentially now with all of the money that's flooded markets, and we've seen people moving up the risk curve. Something similar. Maybe.
That's right. So
anyway,
let's move on to that.
Let's move into the UK. Sorry, guys. So, Dave, what's happened to get us to this point where we've had bond markets lock up this week?
Okay, so the broader context is we've had a pretty decent inflation surge in the US, and so the Federal Reserve there is chasing that pretty hard, and so that's triggering rising interest rates worldwide. And the UK is an example of what's happening to many countries where their bond markets have sold off and their governments are facing some stress in funding their activities. However, the UK has kind of pushed itself to the front of the queue for being bashed up in this environment because the Conservative government there shifted leadership to from Bojo to Liz Truss, and she brought with her a gaggle of fairly radical thinkers who have undertaken a recent budget which did some pretty unorthodox stuff and really upset markets. So basically, this is by and large been characterised as neoliberal stuff that's happening in the UK, but I don't think that's right. The people who have come in under Truss are more libertarian than they are neoliberal, and this is important because
actually, Dave, it's probably worth just spelling out the difference between the two.
Well, I mean, your neoliberal is pretty much mainstream economics these days. It's conservative government spending, cutting red tape, liberalising markets, allowing markets to set prices, and pretty much allow markets to run your economy. Whereas libertarian, it takes another step where it's really all about trying to wipe out government, have as little regulation as possible, as little taxation as possible, and to let the private sector just, really run things the way it sees fit, without any inhibitions whatsoever. So they're openly hostile to any form of regulation or government. And so what they've done with this new budget is to inject tax cuts into this circumstance of a tightening Federal Reserve and some inflation problems worldwide. Now, the UK itself has quite high inflation, quite high wage growth. It's running a big current account deficit and a budget deficits. And in the neoliberal world, the last thing you would do in that set of circumstances, especially if global interest rates are rising, is to cut taxes, because what that does is stimulate some demand, depending on which taxes you cut, drives your budget deficit deeper, probably drives your current account deficit deeper as well, and potentially lifts inflation even further. So, you also have the Bank of England trying to tighten interest rates. And so you can see how these two policies work against one another, where the central bank's trying to damp inflation in the UK, and then the UK government's come in and said, no, tax cuts, deeper budget deficits make the economy grow faster. So there are a number of issues with this in terms of execution as well. Like, for instance, they're basically high net worth tax cuts by and large, so they probably won't do much for demand.
Or inflation.
They may not drive up inflation further, but they are going to create a deeper budget deficit. And in this circumstance where all governments everywhere are being forced to higher interest rates to fund these deficits, the UK is toying with actually creating, for instance, itself an external crisis where it has trouble funding itself. Now, as I said, the neoliberal solution to this circumstance has been expressed by Martin Wolf at the FT. The IMF came out extraordinarily and basically condemned the UK government for what it's done. And perhaps most importantly of all, of course, is the market reaction to what it's done, which was to immediately flog gilts, which are UK debt. Nobody wanted to buy them. They got dumped like nobody's business, and the pound absolutely cratered. So that tells you that how radical this policy was, and mistimed, because the markets were just kind of reeled in horror. So what's now happened? We've had a couple of days of outright crisis, basically, where in effect the UK is plunging into a sovereign debt crisis, more reminiscent of emerging markets than a developed market. And the BOE, the Bank of England, has come in last night and said, okay, well, markets are behaving irrationally. This is disorderly. So we're going to buy some of these bonds of the UK government, which overnight has worked to sort of settle things down. Interest rates have fallen back a bit in the UK, and the pound has stabilised, and a bunch of other things have happened. But you have to ask yourself how long that can last, because...
Also, do you think that markets were actually reacting irrationally? Because it doesn't sound irrational to me. That's just what they said,
No, I
right?
don't think they were, no. I mean, this is... And I think you can say that the BOE is acting pretty irrationally. Because what they're doing is printing more money to buy debt, to inject more demand into the economy so that they can raise interest rates and smash the economy. That makes no sense whatsoever. The two arms of UK macroeconomic management right now are just punching each other in the face. And so this is a really bizarre set of circumstances that I think you can characterize as, we've been discussing for the last couple of years modern monetary theory, and this is what got much of the world, or the developed world at least, through COVID, which is this idea of MMT, where the central bank directly funds government spending through printing money. It just buys their bonds. Now, typically it's argued that should be used for a productive purpose, usually in infrastructure or government services that are going to lift the economy in a more useful manner. But what we're basically seeing here is a coup from a pack of crazed libertarians, an MMT coup, where the central bank is now funding tax cuts for these ideological nutters, for the rich, right? Yeah. So it's a really wacky set of circumstances, and I think the market reaction is actually pretty appropriate to it. So
it also sounds reminiscent of something that you might hear from an emerging market country.
Oh God, yeah.
Which is why it is important that IMF said something.
Yeah, where you have a government captured by elites, like an oligarchy, who are like, yeah, we want more money, cut our taxes. I mean, and you could argue that that's all this is, as well. That all of these trust guys came out of a thing called the Institute of Economic Affairs, which is a kind of radical trickle-down think tank that has links to lots of rich people. So, that's one way of actually characterizing what's going on, is that it's just a case of emerging market corruption, transplanted into the UK. So the interesting question to close out this section of what we're discussing is has the UK done the world a favour here? Because it's got by triggering this market reaction, it has it kind of, I guess, sent up a warning flare for this direction of macroeconomic management for everybody else, and so warned them off going this way as we push ahead into the end of this cycle and the beginning of the next. Have we actually reached the outer limits here of radicalized neoliberalism or libertarianism? Because you've had this experiment in directly funding tax cuts from the central bank, and markets have recoiled in horror, which is just, terrific and appropriate reaction. So,
But Dave, I'd then question that and say, well, has it done that? Or if you're aspiring to the same thing in another developed country, say it was you were a Trumpian figure, and you somewhere else, and you've seen what's happened, and you're like, well, this is exactly what I wanted to happen. The central bank stepped in to save it. I can do whatever I want. I can hand out as much money as I like.
I guess that depends on
the fact that.
Well, it depends on how this plays out. Obviously, whether the BOE has saved it, because
and whether they get them through, like whether they actually.
Yeah, well, I mean, the BOE has said it will buy bonds for 2 weeks.
Yeah.
Right.
Not
at the same time, it's got an agenda of running down bonds it's previously bought by 80 billion. It says this isn't going to disrupt that.
Right.
Yeah. And it's going to keep raising interest rates, which is obviously going to squash, the private sector economy.
Yeah.
I know you're playing devil's advocate.
But I'm also saying it needs to be severe enough reaction that because if it's a bit of a mild reaction, then others will go, yeah, sure, that's
it could be a bad idea that everyone will love. That's right.
Exactly. Yeah.
So, well, I mean, we're just asking that question, really, aren't we? Have they done everyone a favour, or maybe it's the slippery slope, the first step at the top. Well, it's just not clear at this stage. But I guess what at least I agree with it, I think the market reaction is appropriate. It's not irrational. So,
and the other thing I'd add as well is that they could get lucky. Like, I mean, stuff could happen now that means that that inflation doesn't get out of control, and whatever it is, and you get a nice warm winter, and you get lots of wind resources, and energy prices come down, and you end up with this scenario where a whole bunch of things fall in line, and this really bad policy, which should have caused problems, will cause problems later, but not maybe it takes a couple of years before the problems really start, and so then maybe it spreads.
A rainbow may whack them in the ass. Yes.
Yeah, and that's the problem. That's your that's one of my major fears for inflation. Really, is that you go, as Dave says, a rainbow slaps them in the ass. They don't see the problems with it for the moment, and then a bunch of other countries go, "Hey, that sounds like a great idea," and then next thing you know, you are facing some serious long-term inflation issues as everyone tries to fund tax cuts for their favorite mates, using central bank money.
Yeah, and currencies collapse worldwide.
Yeah, so not a base case, but it's a risk.
I mean, if they're only funding it for their mates, is it really going to increase spending to the point that it is sustainable ongoing inflation? I mean, I thought we'd already largely come to the conclusion that trickle-down economics doesn't work.
No, it doesn't. But if you do big enough tax cuts, it'll affect the economy.
All right, so it depends who it's for, right?
And there are, it's the issue about saying, okay, if I took $100 billion and spread it out to the lowest earners or spread it out to everyone, then I'll see this demand pick up from that, and the money will bounce back around and circle. That 100 billion will turn into multiples of that 100 billion because it'll get respent. If I take that 100 billion and just give it to all the richest people, there's still some effect. Like it's still a positive effect. It's just nowhere near the benefit you'd get from spreading
absolutely.
it out. But it's not a negative effect. It's not going to, it's not going to.
It could be just a non-zero effect, basically. That is marginal,
Yeah,
and it really depends who it's going to. Is my point.
Yeah, that's right. And I think there's from our perspective at least, the well-targeted money, which does get that multiplier effect, that's where it can go on to pay for itself. And sure. So, I've spent this money, I've given it out to people, demand increases, we build a bunch of, infrastructure that we needed to build and whatever it is, and that helps generate the next level of productivity. And so, and then taxes end up at a higher rate and we've paid for our things. So that's the grain of truth at the heart of this whole thing. But then the problem is, if you just give it to all the rich people, it doesn't do that multiplier effect. It goes into people's bank accounts and investments.
Is there also a difference between tax cuts and because I feel like a large part of why we said trickle down economics hasn't worked is because of the flooding we've seen from central banks over the last few years, but really that's been in terms of financial assets, and so it's an increase in wealth but not necessarily in income. And I don't know if there's a difference among the wealthy to be more predisposed to be spending increased money, cash that's coming in, as opposed to liquidating assets and that sort of thing.
I think it's almost the definition of being wealthy is that the amount of money you have far exceeds the amount of money you're making.
Right, so it's irrelevant.
So if you're not, I guess what I'm saying, if you're not wealthy, you might be not wealthy, you might have zero, but you're earning $500,000 a year, but just spending it all. Is that you're not going to benefit from assets going up, or rather if you're spending $500,000 a year and spending it all, or if you're earning $20,000 a year and spending it all. Mm-hmm. But the wealthy who are tend to be the ones who have these massive millions and millions of dollars of investments, right. And then that's so they do benefit disproportionately because they're not, whatever their income is, it's a fraction of their wealth. Yeah.
Thanks.
So next up, we thought we'd just expand out and look at some of the other countries in this context of rising interest rates, see where they're situated, and see who may be suffering from some of these same pressures as the UK. And then we'll have a look at Australia as well in a moment. So I mean, the key driver here, I think there are two actually. The key drivers are the Fed is still not done in the US. We don't think inflation has come down a little over the last 3 to 4 months, but the measures it looks at, which is core PCE, is the key one, still up around 4%, double target. Wages growth is still very strong. On the most recent numbers, up around 6.5%, 6.7%. And so, and the other probable key input over the last couple of months in the US economy is that the petrol price, not so much the oil price, but the petrol price has really come off heaps, probably 30-40%. And so there's a fair bit of stimulus in that as well. That's kind of lifted, a bit of short-term US activity. So in short, the Fed's going to keep hiking. So this context is going to get tougher.
And it's worth noting, Dave, we've done a reasonable amount of work during the week just on timings and looking at sort of the different scenarios about, if you had a very deflationary outlook or if you had a very inflationary outlook. And the thing is, given the way you're looking at base effects, so when did the inflation kick through? And because a lot of the inflation sort of kicked through in that March, April, May sort of time period, you're actually waiting a long time before you see, even if you've got quite a deflationary outlook and you thought these things are all going to start reverting quite quickly as the transport costs came down and wholesale car prices and retail car prices start to fall and all that. We're still talking, into next year before you're getting reasonable rates for inflation, even if you had a quite annualized inflation. So, I guess we ran a few that sort of looked at, effectively running deflation for the next few months, and you just a little bit of deflation, every month on month, but it's not until next year where you're actually starting to see inflation levels, even under those scenarios, fall back to more reasonable levels. So I guess the net effect though is that the Fed's going to keep hiking.
Yeah. So this context, that created the pressure for the UK drama is probably going to get worse, almost certainly going to get worse for the time being. So we don't see a lot of, imbalances in the US economy at the moment either. And so, that sort of frees the Fed's hand to keep tightening as it sees fit. And we also have the midterms around which there's always going to be some extra spending, etc. So in short, it's going to persist, this environment, for a little while. So, and it doesn't look like the US is immediately going to break. I mean, slowly the vice is tightening, but not breaking down. Although obviously asset markets are starting to, and that could lead to a more sudden change in economic behaviour. So,
and the odds are that we're going to end up with a split. The Republicans will end up with the House, and the Democrats will end up with the Senate. Neither of the odds are far and away, are shoe-ins, but they're certainly, that's the way it's pointing at the moment, which probably means not a lot of more spending, and relatively limited, fiscal stuff from the US for the next 2 years.
Yeah. So swinging over to Europe, it's in a better position than the UK in aggregate, but there are quite vulnerable parts. The wages growth in Europe is much lower than the US, and the UK is about 3.8%, I think, from memory. So that gives the ECB a little bit of breathing room, but of course they've got very high inflation, particularly from energy, and also the euro's been getting such a battering from the tightening Fed and the war. They're going to get some tradable inflation that's making the energy price. But there are, within Europe, there are various countries, formerly known as pigs and stuff, that are still carrying pretty large twin deficits. And, we've just seen a very far right government elected in Italy, for instance, that could take the fight for some kind of sovereign support to Brussels in terms of either energy prices or Russian policy, all sorts of things around its own bonds. So I mean, there's a sort of quite a bit of dry tinder, if you like, across Europe that could find a spark amid rising interest rates, and we could see something happening there, especially as the ECB is hiking rates now at sort of 50 basis points per meeting, the wisdom of which, we'll discuss later in this poddy. But, there's a vice there for European growth, rising costs, rising interest rates, and a sinking currency. And so growth is very troubled. So that's an environment for possible crisis. Swinging over to China, and we've talked for a long time, a couple of years, about China's impossible trinity, which is its attempt to manage capital flows, interest rates, and its currency value all once, and you can really only manage two.
And this is not China's specifically. This is everyone's.
No, that's everybody's problem. Of course, it's just particularly critical there.
China doesn't have China's flips between which ones it's using, whereas most other countries have got some open capital flows and floating currencies that sort of manage that problem for them. Whereas China's trying to control all three of them to a certain extent, and flipping around which ones it's doing.
That's right, and trying to extinguish its ginormous property bubble, which so far it's succeeding in doing, but of course that's demolishing domestic demand, so its growth profile is slipping dramatically. And it's wrestling with zero COVID, which is making that worse. And, as Europe is hit and the US slows all of its wonderful export growth, and current account surplus is also going to come under considerable more strain as we move into next year. And so there's a lot of forces negative headwinds coming to bear on Chinese growth. They're inhibited in terms of being able to cut interest rates to save their housing market because they're afraid of a tumbling currency owing to capital flight. And that's their sort of worst case scenario, where they're concerned that, the renminbi will fall so fast and so far that it could either force local interest rates up and make its housing bust worse, or trigger, geopolitical backlash via trade. And I think yesterday for me was a bit of a crossing the Rubicon in markets, in terms of the viability of this being a crisis for China. The PBOC has been fighting the falling yuan for the last week or two, and yet yesterday when we had this little UK bushfire, the yuan absolutely crashed. Went straight through all of the PBOC's efforts. Sure, it's up again today, but it plowed straight through to 14-year lows. All technicals were blown to bits. It just looked like a free-floating currency in free fall, which I've never seen before in the yuan. And if things do get really tough in the terms that we're discussing, then there's no saying that the yuan is particularly stable. It looked yesterday like the PBOC lost control of its currency. So the impossible trinity is breaking down in China, and that throws up, the real danger of a Chinese external crisis, which seems extraordinary given it runs these massive current account surpluses, but it's possible. So the last one we've got to look at briefly was Japan, and it's the last holdout against the changes in central bank reaction function, if we call it that.
Except for China, which is going the other way. So. Yeah.
Oh yes, of course.
But the last
developed market. Yeah, that's what I meant. Developed economy. It's still printing like crazy. It still has yield curve control, which is buying bonds to fix interest rates to a certain level. But it has been getting nervous about the yen falling so far as a result, and has also started to try and push back against that. But
so they had been saying for a while there that yen falling was a good thing. Stimulates demand and whatever.
They've pivoted now.
Exactly.
And inflation. Maybe they'll get some inflation out of it.
Yeah, they are getting some, but it's the wrong kind of inflation as usual.
Doesn't matter? I thought that's what central banks have been telling us now. It doesn't matter.
Well, matters to the BOJ. Sorry, I'm just trying to turn this phone off. And so I don't know whether they're going to break and stop printing, or heaven help us even lift interest rates. I still find it hard to believe, but that is one possibility as well. And it would actually be a kind of, I think, elegant finish to this whole inflation panic if they did break. I think that'd give you one sort of final yield shock around the world, and then everybody would end up printing again within a couple of weeks of Japan rolling over, I suspect. So anyway, the general context that I'm trying to describe here is one of stress in sovereign debt in developed markets, and we haven't even looked at emerging, where there are any number of possible candidates for stress turning into crisis. Okay, so swinging over to Australia and how we're faring in this, and we're actually pretty good, relatively speaking.
So far, like our wages growth has been much lower than elsewhere. We've obviously tried to lift that for many years ourselves and campaigned for it, but so far it's been, quite weak, relatively speaking, very weak. So that's giving some scope for the RBA not to over tighten and smash domestic demand. I'm not particularly, of course, what that is resulting in is a very fast falling currency. The Australian dollar has absolutely fallen out of bed and looks like it will continue to as those yield spreads, that is the difference between our interest rates and others, especially like the US, gets wider and wider. The currency gets weaker and weaker, which does inject some inflation. But I think given the environment we're going into, where I think global demand is going to be shocked over the next 6 months, say, as the Fed gets its job done. I think in that environment, the falling Australian dollar is unlikely to generate much local inflation and pressure the RBA, because in those circumstances, with weak pricing power for corporates and importers and exporters, you tend rather to just see margin pressure in the companies rather than it being passed through to end users, retailers, consumers, etc.
Is that a function of how long it lasts for, though, Dave?
Yeah, it is. And so if we don't get a crisis that slows global demand, then it will generate some more inflation. But I think the odds are that the idea, in a sense, the falling Australian dollar is telling us that there's a crisis underway here that's going to hit demand anyway. And so I'm not really concerned about it delivering inflation. And corporate margins are just so huge at the moment coming out of this whole inflationary spike that they're inevitably going to contract. And so I think that's okay. It would, however, be very helpful if the Albanese government, got off its butt and fixed our energy crisis. The latest information flow on that is that they're not getting along very well with the gas cartel, which is good news, because the last thing we want to be is friends with the evil gas cartel. The only way you could be friends with them is to allow them to rot you mercilessly. So hopefully that rocky relationship is indicating that they are pushing hard to get, energy price caps into gas. Unfortunately, they should be doing coal as well, but that's such a timid government that God knows I can't see them getting there. But at least getting onto gas would limit the fallout from the global energy crisis, and again offer the RBA, scope not to be driven to higher interest rates. We actually are running a budget deficit, but it's been improving, pretty substantially, given the economic reopening and very high, extremely high commodity prices over the last 6 months. And so its trajectory has been pretty good, and we're running like a juicy current account surplus as well. So in short, our profile, although we're a small developed market, is actually pretty good in the context of kind of rolling sovereign debt crisis amid rising global interest rates. We're not something that you would point the finger at immediately and say, well, you're at risk.
from the government side.
From the government
obviously
side.
China is a problem.
Yes,
Yeah.
well, this is right now, and there are a number of different dangers that if this does get unruly, then it will challenge Australia. Now, danger number one is bank funding costs, which it always comes back to that with global crises for Australia, and they have been rising at a pretty good clip, which would obviously throws up the possibility that you get out of cycle rate hikes for mortgages and stuff from the banks, or alternatively, if the RBA stops or even cuts, they don't pass it all on. We're all pretty familiar with the dangers that represents these days. And we have an incredibly vulnerable household sector. Like I mentioned earlier, that the US doesn't really have any obvious imbalance. Well, Australia does. Our household indebtedness remains completely insane, and so if for one reason or another global markets or via the banks or the RBA itself is forced to push interest rates up much more, then obviously we're going to have a pretty big growth problem on our hands as house prices come apart, as they already are. So,
and also noting that the Australian consumer is we've got a lot more. You don't see variable rates in a lot of other countries. A lot of other countries have fixed terms for mortgages,
yes.
and some of them, say the US, they're really long. They go for 30 years, whereas Australia. So as rates go up in the US, it affects new home buyers. Doesn't affect existing homeowners, whereas in Australia it does. And so interest rates have a much faster effect, and we're much more vulnerable because we've got so much more debt.
Yeah, which is why house prices in Australia and New Zealand have led global house prices lower. Basically, the transmissibility is much quicker. And we have, of course, the fixed rate mortgage reset starting in the next half in proper, which is going to make that worse. So definitely see further falls in house prices. Now, I didn't put this in, but you could say danger 3 is that China does end up being ground zero for this global crisis, which is plausible, and our commodity prices crash, and that would drag Australia into, this, let's say, the end of cycle event that we're discussing. However, we actually have a different mix of commodity prices right now that would probably do okay, even in that scenario, because energy is at unprecedented highs because of the Ukraine war, and is unlikely to come down even in the event of big recession, I think. So I'm talking LNG and coal, thermal coal in particular.
Mainly coal. Yeah, LNG prices are high, but we just don't make much in the way of royalties from it. So
well, we make better money from the Western Australian exports, which is the majority. It's about 2/3 of it, I think. So, at least we'll see it. We don't see much action on the royalty front there, but we'll see a decent uptick in corporate profits. On the WA side, the East Coast is a disaster. That's a wipeout. So we don't get anything out of that, but we do get a little bit out of the West. But yeah, coal, I think thermal coal, might be both coals at this point, are as big as iron ore at the moment. So we have some offsets that are some uncommon offsets or idiosyncratic offsets that would mean even if China gets drawn in, with our trade, I dare say probably wouldn't still be a surplus, but maybe our trade deficit wouldn't at least crash to alarming levels, because our offshore earnings in some of these commodities would be sustained. So, I mean, it's not a bad set of conditions, relatively speaking, for Australia. That said, if it really does go the way of the China accident, then I think we're certainly going to see some heavy turbulence. So the next page and the next idea for what we're going to do here, having kind of set that scene, was just look forward a bit and see what is the most, offer some scenario analysis basically, and see if we could figure out who might be at risk and who's going to go, and what it means for growth and asset prices. So, I mean, the first one, and I think this is a sort of fading hope, is just that the Fed manages to cool inflation, quickly and without breaking anything. We're obviously reaching a point where that's, not looking like the base case anymore. If it were, and you could get something, I don't think we're ever going to have a soft landing killing this inflation burst, but at least it would have been a modest to moderate recession. And I think a modest to moderate recession in the US is probably the most likely outcome at this point. It's more other dimensions of the global economy that are at risk of more severe downturns. But that scenario of a soft landing is almost gone, I think. So the second scenario is basically, I think this is the one we're at really, and that is, the Fed just tightens until it breaks something. This is, something that you'll be hearing not just from me, but around the traps. And in this case, I don't think the UK is substantial enough to upset everything. But what it could be is like a Bear Stearns moment where, it's a warning of what could be a bigger victim to these circumstances before too long. In which case, or maybe it's many Bear Stearns. I don't know. Maybe there's no Lehman in this particular process where we get, as Damien said, the Minsky moment, and something big enough just really takes down markets all over the joint, and it's a sufficient shock that the Fed is just simply forced to stop and probably reverse pretty quickly if it got bad enough. So.
And actually, we're going to go into more depth on what can go wrong next week. So next week,
we'll try and dig into what we think might break. But because
there's half a dozen candidates, but
there's a whole bunch. There's a whole bunch. So at this point, I guess we'll leave that till next week. But I think probably the key takeout here is that the second scenario is the base case, that we are at a Bear Stearns moment, but we're either going to get a lot more Bear Stearns or a Lehman that's going to go down and take us into a pretty decent global recession, within which I think the US would probably fare the best. So extending that forward some more, is this shock going to be ultimately deflationary or inflationary? And taking it back to the UK, will it result in governments, doing more radicalized MMT with God knows what tax cuts and any other kind of crazy ideas they have to fund the rich, or will it actually create a backlash against MMT entirely, and we come out of this, basically with the bond vigilantes having returned and forcing austerity onto various governments around the world, and so a deflationary shock becomes a new deflationary cycle.
We're all Austrians now. That's right.
Yeah, we're all Austrians again, and I don't know at this point. I would say though that I suspect, the nature of the structure of our contemporary economy, with its financialized aspects, debt structures, market structures, and now energy,
high housing prices,
asset prices, is that I think that the great likelihood is that as we go through this interest rate shock, we'll get a rout in prices, and rather than it being followed by a clearing of debt and what have you, central banks and governments will be forced to go straight back in and do it all over again.
So I guess in a way, just to I guess illustrate is what we're talking about here is in the UK is you've got these, as said, two arms of the government working at in opposition to each other, and so it's your irresistible force meets your immovable object, and it's basically saying, well, on one side it's much easier for the central bank just to keep hiking rates. Like they don't have to change what they're doing and go back out to people and talk about it. They're just, if the economy's running hot, they'll just keep hiking rates until they break something. Whereas, you've had these new policies, new tax cuts. Well, do they need to come back with another set and another set and another set? I'm not saying they won't, but it's we've got these two titanic forces reaching each other. One of them, and chances are, with them pushing against each other so hard, you're going to go one way or the other. You're either going to go to more extreme inflation or deflation. It's unlikely to be this nice little moderate outcome for these two big forces. So the question is, which one gives? We think it's probably that the central bank prevails, but maybe not. Maybe they change their view and they're not.
Yeah.
They look at it and go, well, we're in such face here. We are going to cause a depression, and we don't want to cause a depression. So maybe we'll ease off. So
yeah. Well, that's the, I guess, structural discussion. I would say the cyclical. I mean, at least for investors right now, what matters most is the cyclical point in time, which is, the central banks are going to win in a cyclical sense. They're going to crush everything. So that's in terms of an investment opportunity. I'd say that overrides this broader discussion about what happens after. So I think we're going to have a deflationary shock. It's a case of what these two arms of macro management do afterwards, and with the ongoing energy struggles coming out of Europe, which are going to take a couple of years to ameliorate. There'll be, some more inflationary dynamics than usual to deal with. But that is unclear at this point how that's going to play out. More focused on the denouement of the cycle itself. So that's kind of my wrap. And we thought we'd go full circle and come back to Shelley's question at the beginning, which is, are independent banks, working and worth having? Are they serving social utility and behaving in a manner that befits a publicly funded institution at this juncture? I'd start by saying, a lot of the inflation that they're fighting is supply side, and so there's a pretty good argument, in fact, that they should just ignore it. I mean, they can't directly affect supply side inflation. What they can do is kind of diminish demand to make room for that supply side inflation. But in effect, what you're doing there, and this is the enormous risk for Australia, is you're creating a huge wealth transfer from workers to war profiteering energy cartels. And is that reasonable policy? I mean, really? Yeah. In the case of Europe, okay, maybe their choices are more limited because they are a big energy importer, and maybe in the case of others that are energy importers, that's a binary as well, but a bind rather. But at least for energy exporters, that's not really something that you should have to confront. And so hopefully Australia will make that realisation and shift policy accordingly to curtail energy inflation locally. But I mean, I put it to you guys, is that a reasonable thing for central banks to do?
Well, and I guess I'm coming from a broader sense of saying, 50 years ago, we relied on our government to work out which was best. Should I be using fiscal policy at this point, or should I be using monetary policy? And I guess I put it that if the UK had come out and said, hey, we've got this huge inflation problem, I'm going to run exactly the same deficits they said they're going to run, but I'm going to pour a whole bunch of money into renewable energy so that we solve, or nuclear power or whatever it is, to solve this problem, so we don't have to come back to it again. And we're going to, and we've got all these other things. We're going to redo our training, and we're going to cut costs from, we're going to make our hospitals more efficient by doing whatever to it and spending money in a particular way. That's a genuine, I have my two arms of governments, and the central bank isn't doing stuff because it's relying on the fiscal spend to bring that inflation down. Whereas at the moment, we've got both ones sort of effectively, I think, it's this part, if you set up rules, then everyone tries to game the rules. And you've effectively end up now with the politicians effectively saying, well, we're just going to blame central bank for anything. And we're going to sort of, it's almost like, oh, no, we're not running the economy. We're just here to give out, free treats to everyone. Hey, tax cut for you, more money for you, hospital over there, car parks over here, running the economy. That's not really my job. My job's just to play Santa Claus. And then if anything goes wrong, let's blame the central bank. And I think that's where the problem is that we started with, effectively the government's doing both. And then it sort of ended up with these independent central banks, which made a lot of sense in terms of saying, okay, the government's going to do it in concert with they're working together to run our economy. And we've got somebody here we've got some independent people who are prepared to put rates up, and pull away the punch bowl and be a bit more adult about, how do we slow things down before there's a crash. But it seems as if we've, certainly in the UK, the pendulum swung too far. Now the question is, for me, is saying, well, if that ends up being, the modus operandi right around the world, then maybe eventually the pendulum will need to swing back the other way and go, well, okay, somebody just needs to run both. And in one sense, you could say, well, maybe then now you make your government spending independent, and you just say to your politicians, here's how much you're allowed to spend, you decide. But that sounds unlikely. I don't think there's too many politicians who would be willing to, put that forward and say, yes, I'm going to give up my ability to spend however I see fit. So yeah, I guess the net effect of it for me is saying, it's a really interesting point of time we need to be focusing on now in terms of saying, which way is this going? Because if it's going down the path of more opposition and more central banks working at cross purposes to governments, then we're in for more instability and more volatility in terms of asset prices and markets until there's resolution.
Well, there are a multitude of tools available. It's the coordination of them that's impossible. I mean, as you say, if you push back the other way and put it all under the one umbrella, well, I mean, if you've got good people with good ethics, it will work great. But I mean, that's just not the world we live in.
No, that's right.
Like the idea of giving.
Did we used to? Should we be nostalgic?
No, I think there are sort of occasional outbreaks of good people and rationality, but
they're quickly snuffed out.
They're quickly snuffed out. Yeah, I mean, the people who wrote the U.S. Constitution, that was one. We probably had a bit of a rational outbreak here in the 90s, but these are rare punctuations of what is generally pretty
self-interested
and corrupted system. Yeah. Which is constantly under pressure from money itself, and so yeah. I mean, I guess it gives us all a job, observing and poking and prodding the beast.
Well, I think we've probably got some questions.
We've got a couple of questions that have come through. So we have one from Carsten. He's asking, is the turnaround in bonds likely to come quicker, or turnaround in bonds, or have any effect due to the UK crisis?
I would say the base case is that's the Bear Stearns moment. So I think it's possible we see another spike in yields before enough or something big enough breaks, and the Fed's forced into rapid retreat. But I think that's the likely scenario. Is if there's one thing that I think I'm sure the Fed realises what it's doing in terms of the tightening, the impact it's going to have on the economy, and the fact that it's going to really create a recession at home and more fulsomely abroad. Like, I think it knows this. I think where it's probably going to be surprised is how quickly it happens when it does break, because of the structure of the contemporary economy, where when things go to shit, they really do go to shit fast, being so financialized. So, we'll just see a lot of markets break and freeze up at once, and it'll have no choice, but it'll have to just go into reverse. And so, at that point, you're going to see a rampaging bond bid. I don't think we're quite there yet, would be my best guess. Could be wrong, of course.
Okay, nice one, Dave. And we've just had another question from Chris G. So he's asking, do you believe that the Treasury and the central bank should just officially work together to generate more effective and coherent fiscal and monetary policy?
Well, they do work together officially. Like the Treasury has a representative on the RBA board, and they obviously talk all the time and stuff. I mean, at the end of the day, the problem is that these things are all made up of people, and we're all hopeless. So,
but it's also
can establish the rules as best you can, but you always end up with some nut doing something stupid.
Well, and that's the issue, is when you get somebody who says, no, this is what I'm doing, and I'm not changing. So this is your, I want a balanced budget. I don't care about demand. And actually, in a way, from saying that the way the economy was run for that time period, while you had a government sort of searching out, trying to get to budget surplus, while you had a central bank, busily trying to lower rates to raise it. In a way, that's political genius. I mean, it's a terrible economic set from a long-term perspective, but from a short-term perspective, you've got rising interest rates and low wages. Yeah, and so businesses are all happy, profits are coming through, and you've got rising house prices to sort of help ease the concerns of the masses, but in the meantime, we've got no wage growth and falling per capita incomes, and so. It's sort of that part where you do need to acknowledge that whoever's getting voted in, that there will be people with ideologies that are basically, this is what's going to, who are fixated on those ideologies, and I guess what I'm getting to is, in a way, I sort of feel as if maybe in some of these cases, if you could have the same government in the UK and say, okay, you're running both fiscal and monetary policy, and now everything's your fault. You can't blame, if you want to have huge tax cuts and all that type of stuff, great. But then you're going to have to do some work on the fiscal side as well. And if the whole economy implodes, it's all your fault, and you'll be voted out and you'll never get back in. As opposed to effectively them playing chicken, saying, "Oh, we're going to drive the car straight into the interest rates," and your technocrats have to get out of the way and or do what they can to try, and they're doing everything they can to try and make sure the economy doesn't crash, just because. You've got one mad driver who wants to drive the wrong way down the freeway.
Well, the quarantine.
Yes.
I'll take one more quick viewer question here. So this is from Tim Jude. He's asking, do you guys have any indication where the Aussie dollar is heading? And he's saying, given our commodity and energy export strength, at what point does the Aussie dollar lift, especially against the greenback?
I don't think the energy stuff is relevant to the dollar right now. We're simply being mown down by the extraordinary forex volatility with the US dollar being on an absolute rip-roaring tear, which I don't think is over, and the crashing yuan. Like, those two things are fatal for the Aussie dollar in terms of the US. it's holding up better against a lot of other currencies. But in terms of the US, which is what matters because all of our exports are priced in US dollars, the commodity exports. So I think the Aussie dollar's in for a hiding.
Okay.
Yeah,
You got more to add, or do you want to leave it at that?
Well, it's been smashed, but I think it'll continue to be smashed until the Fed pivots. But when the Fed breaks something, the Aussie's going to crash there. That's when you'll get the turn. But it'll.
And one of the things that could break could be the Australian consumer.
Yes,
through mortgage rates.
But at the moment of the accident, the Aussie dollar will absolutely fall through the floor. So if you're looking to pivot towards a rising US dollar, that's the moment you should be looking for.
So a rising Aussie dollar.
Sorry, yes. If you're looking for a rising Aussie dollar, then that's the moment where you're looking for a bottom. Is when the Fed breaks something. It will certainly include the Australian dollar that it will break.
Okay, nice one. So now we've got our viewer question of the week. So this is for viewers to have some discussion in the comment section over the coming days. The question for this week is, which central bank should Australians fear the most? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days.
And can I add in there, for people who are wondering what that's talking about is, the Chinese central bank could blow things up in China. The Fed is raising rates right around the world. The European central bank could obviously cause problems with Italy or the pigs. We could have the UK central bank fold, or we could have the RBA.
The lunatic RBA
going crazy. So there's a lot of candidates there. So,
Yes, there is.
Yep. It'll be some interesting chat on the comments over the coming week. So that almost wraps us up. So just want to thank everyone today. Damien, Shelley, Dave, thanks again. We always value your insights. And next week's episode, it's going to be called "Which Economic Imbalance Will Be the First to Crumble?" So that's sort of part 2 of today's episode. So we're all looking forward to that. Thanks guys. Thanks again.
We may be looking at that in retrospect by next week.
Excellent. So we do welcome your feedback on the podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comment section below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact and you can book a call with me or one of the team. Don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, would really appreciate it if you can please share it with them. And also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can follow us on all social media. So from myself, Damien, Dave, and Shelley, we look forward to seeing you next time. And bye for now.